think the key thing is what we saw in the Fed funds futures market is that rate hike expectations following the inflation numbers for next week stayed at around 3%. So there's a very low probability of a hike at the September meeting. And even the probabilities of a rate hike for the November meeting dropped down to 32.6%. It was recently as high as 50%. I think that's for a couple of reasons. Number one, you saw the ECB do one hike and basically say they were done, which implies with the US inflation being much lower that the Fed may in fact be done moving forward. But I think the buoyancy in the US markets overnight was largely due to the ARM Holdings IPO. This was a big success on the NASDAQ, and that opens the door for many new IPOs and animal spirits to come in into year end, which will create a lot of fees for the large banks, which is a good thing.
Okay, so Hayes, interestingly, while overall inflation is running above expectation, U.S. core inflation or core CPI for August 2023 aligns with expectation. Core PPI for the same period also met the forecast 2.2% year-on-year. So how do you see this data as a sign of stability that maybe the Fed is going to maintain its interest rate on this level right now?
Yeah, this is a big deal because the Fed focuses on core inflation, which backs out food and energy, because energy, as we know, is very volatile. So this is the laser focus of the Fed is core PPI, core CPI. And to your point, they've stayed subdued here on the core PPI at 2.2 and the core CPI in line with expectations. So this sets the stage for the Fed to walk back and to show that they are on target. And that's why I think you're going to see those November expectations of a hike continue to decline as we move towards it and we get more data both on the inflation numbers, but more importantly on the employment numbers where average hourly earnings have started to be more subdued. And that's a positive thing from the Fed's point of view.
Okay, in addition to inflation, other economic indicators are causing volatility. For instance, U.S. unemployment claims for the next week, for the week, ending September 9th, 2023, rose to 220,000, slightly above market expectation. So how do you see about this one and how this will cause effect to U.S. economy?
Yeah, so the initial jobless claims came in a little bit lower than expectations. They have been trending up. The labor market is loosening up, which is a good thing because as people are spending down their excess savings that they received during COVID and they're running out of money, they're going back to work. And what we saw in the most recent jobs report is that the labor force participation rate increased to 62.8%, which means there's a new supply of labor. More people are going back to work, which gives the employers the upper hand, and wages have stopped rising, which is a very good thing from the inflation standpoint and gives the Fed cover to start to back away from the aggressive tightening cycle that they've been on for over a year now. So as we see more and more people go back to work, wages will remain steady and the Fed can back off.
Okay, and despite the inflation data, however, the Federal Reserve in the United States seems to be adapting to a different stance. Just like you said earlier, that the CME FedWatch tool indicates a 97% probability of the Fed maintaining interest rate in the upcoming weeks. So how this will affect the financial market across the globe, both for developing and developed countries, just like Indonesia?
Yeah, this is a big deal. So as the Fed gets out of the way and they stop hiking, which we think they're actually done, what you're going to see is a resumption of the downtrend of the US dollar. If you recall, the US dollar strength peaked in October and fell pretty precipitously into the end of the year. And then we've had these counter trend bounces over the last few months, partially due to the debt ceiling, partially due to continued tightening. As the Fed steps away, what we're going to see is a resumption of the softness of the US dollar. And what we know historically over the past several decades is when the dollar weakens and emerging market currencies strengthen, which is our expectation over the next 9 to 12 months, what you see is a massive inflow of investors into emerging market equities, and Indonesia and China will be major beneficiaries of that shift. So the number one thing that needs to happen, and the team that now supports it, is the Fed needs to be done hiking, which we believe that they are, which will enable a resumption of the downtrend in the US dollar, which started in last October, which will yield investment flows into emerging markets. And I think you're going to see some very positive equity returns in the region over the next 12 to 24 plus months.
Okay, and how about this one will affect to rupiah, for instance?
Yeah, well, as the dollar weakens, I think what we're going to see across the board is emerging market currencies and foreign currencies start to gather strength. I think the rupiah is going to go up in value. I think that's going to be a function of investment flows once the Fed is done tightening and the dollar weakens, which will also be good for the Indonesian stock market and equity appreciation. So I know it's been a bumpy ride for the last 12 months. You've been up and then you've been sideways, but the trend is up. The demographics favor it. The balance sheet of the Indonesian country, low debt to GDP, third largest democracy, everything is in the favor of the Indonesian economy and stock market for the next 24 to 36 plus months in our view.
Okay, and despite concerns over rising interest rates, projections of a U.S. recession have actually diminished. Some experts even say that the United States could avoid a recession in this era of higher interest rates. So are you quite optimistic about this one?
Yeah, there's no question. I believe we are going to avoid a recession. As a matter of fact, we did have a technical recession already last year. In the first quarter and the second quarter of the year, GDP was actually negative. So we had the technical recession. So while everyone's waiting for the next shoe to drop, it actually happened in the rearview mirror. And as we look forward, what we're seeing is earnings estimates for 2024 are actually going up. In the last few weeks alone, for the S&P 500, estimates have gone from $246 to $248 and change. That continues to defy all the pessimist expectations. All year long, strategists have been saying earnings are going to come down by 20%, and the exact opposite has been true. Equity markets have rallied, earnings expectations have gone up, and we believe that will continue to persist moving forward.
Okay, one last question, Hayes. So once CNBC Indonesia has interviewed Joseph Stiglitz, and he said that what the Fed are doing so far is wrong in terms of interest rate hike. So do you agree about this one, or do you have other opinion?
Well, I think that the Fed wanted to make sure it tamped down inflation. If I was king for a day and I was running the Fed, what I would have done is focus more on quantitative tightening, reducing the size of the balance sheet, and less on interest rate hikes, because what that's done, it's created an environment for housing. We have a lot of millennials. The largest part of our population is in their early 30s, trying to start families, trying to buy homes, and this abrupt rise in interest rates has really hurt that demographic in terms of being able to get new homes. So what I would have done is reduce the size of the balance sheet and been more moderate on the interest rate hikes, maybe stopped around 3.5% and brought the balance sheet down by 1 to 1.5 trillion. But what's done is done. It's been successful. I think now that they back away, maybe we'll see a couple of cuts next year to normalize things, bring things into better balance, and the economy will continue to grow and flourish. So I do agree to some degree with your prior guest, but what's done is done. The economy is strong. The excess money supply is there. We do have a lot of money coming in from our infrastructure bills that hasn't yet hit the economy. So we may, in fact, need a little bit of that insurance, and we'll progress moving forward.